Before we head in this week, a few words about the applied level. I'll try to keep it under 2 minutes here. The Understanding Cybersecurity video is done and up. It is in Sector Studies in the Information Technology folder. I will be doing a walkthrough of Palo Alto, and that will be up on Wednesday. Positions, I've started using a new format for the positions video. They'll be posted every Friday at 2 p.m. so you don't have to guess at what time it comes up. It'll just be every Friday at 2 p.m. We are working on an email notification system. Financial modeling for Costco, we will be done as of Monday. We just have a few tasks left to do. We first have to update the model and then create our performance indicators. And once that's done, I'll show you how to do sensitivity analysis. Changing our assumptions and seeing what effect they have on our performance. This will be posted Monday at 2 p.m. After that, we'll be moving on to CapREIT. It will be faster because I don't have to show you how to structure the model. You already know how. I only have to show you the CFA part, the analysis part. How do you analyze a REIT? But as far as the Excel work goes, we already know how to do that. January 15th, the applied level is changing a little bit, getting a price increase and getting streamlined. I'm going to break it down into two modules instead of the 3 that we have right now. I'm aligning it with the way CFA is structured. CFA trains you either for asset management or as an analyst. So I'm going to do the same thing. In the asset management folder, you'll find the applied options, the portfolio construction, and the positions videos that I put up every week. Under analysis, the sector studies, all of the understanding sub-industry videos that I put up, and financial modeling, which will continue on. How it will continue on is we have valuation coming up, which will be on the institutional side, will show discounted cash flow. This is the sell side. Typically we'll do discounted cash flow, and we'll do comparables, which is typically what the buy side would do, which is, I think, a more interesting way to do it. And then we'll look at specific companies, and we won't do a full financial model. We'll only do certain schedules. So, for example, Palo Alto is a good one to do stock-based compensation because it's really complex. So if you can do a really complex company, a schedule for a complex company, every other company is going to be easier. So I'm going to find the most complex companies for each of the schedules and focus on those. Every other schedule will be easier, or every other company will be easier if I do the most complex ones, right? It's also getting a price change, $425 for each section. So you'll be $425 here and $425 here. That is $850. Contrast that now with $440. Seems like a lot, right? But $100 off if you have any CFA level 1 standing, $100 off each one, and another $50 if you are in the mm.com family. If you are a subscriber at markmeldrum.com, you get another $50 off. So it's only $275 for each section, which is $550 versus the $440. So with the discounts, there's still a price increase, but it does bring it down quite a bit. These will now change to 1-year subscriptions, and your content is frozen. So if you buy it today, you get a certain amount of content. The content grows by the end of the year. You'll always have access to that content. If you want continued updates of everything that I add, then that would be $25 a month incrementally for the continued updates after that. But you'd still always have access to this. If you are in before January 15th, you're in under the old terms, which means that you continue to get all the updates going forward without an issue. But I was going to do this in June because I had a certain number of subscribers, and as soon as I hit that number, then it would turn into a recurring revenue model. But I'm going to hit that number before the end of this year. The growth is unbelievable. And with growth comes increase in costs. And because there is no recurring revenue for any of the current subscribers, you keep needing newer subscribers to pay for the increasing in costs. That's unsustainable. You have to turn it into a recurring revenue model at some point, and that's going to happen on January 15th. Okay, I'll have more to say about this in the weeks coming up. Let's head in for now. Rather than going through the economic calendar from last week, we pretty much know what happened. I mean, there were only 2 big events. It was the election and the FOMC. And I think it's probably just worth it to focus on the FOMC press conference in terms of three categories that Powell talked about. Inflation, the current state of U.S. yields, and the election itself, because this sets up, I think, an ugly fight between Trump and Powell. Let's look at inflation. After going through this, the press conference, I came to the conclusion that there are many more rate cuts coming than the market has priced in. Let's see if I can convince you of the same thing. In opening statement, inflation has eased substantially over the past 2 years. Later on, he added that it is on a sustainable path back to 2%. The 3 and 6 month core is at 2.3%. And he did say we expect there will be bumps along the way. So he wasn't put off by the last inflation reading, even though it bumped up a bit. He said, well, we expect that. We expect there'll be bumps because nothing comes straight down, right? I've said this before. It does this kind of thing. So you do have this along the way. For the labor market, nominal wage growth has eased. Labor market is not a source of significant inflationary pressure. And then if we just take a jump down here to productivity, we got those numbers. Productivity, if it stays high, higher wage gains will not be inflationary. And then he said this, we do not need the economy to soften to get back to 2%. That's a big statement. From there will be some softening expected, there will be some pain too. We don't need the economy to soften at this point to get back to 2% if we have these levels of productivity. Read another way, that is saying the neutral rate is lower. Coming back up here, if inflation progress does not continue, we can dial back policy restraint more slowly. That is not saying we can pause. It's just saying we can cut more slowly, but cut. That's not a raise, that's not a pause, that's still a cut, just more slowly. Getting into the components of inflation, non-housing services and goods, 80% of core, back at levels consistent with 2% core. Job done on 80%, job done. Housing services, the rest of it. Older leases are turning over, but you have base effects year over year, but points to the month-over-month market rents, which the year over year is not catching. Month-over-month market rents are not an issue. He's saying what needs to happen is happening and has happened. Loves the word happen. What needs to happen is happening and has happened. This is not somebody who sees inflation as a problem any longer. 80% of it consistent with 2% core on a sustainable back path to 2%. Labor market is not a source of significant inflationary pressure. We do not need the economy to soften to get back to 2%. What needs to happen is happening and has happened. Job done. I would look December for a 25 basis point cut, and probably the first two meetings of 2025, I'd look for 25 basis points there as well, and probably another two through 2025. So one more this year, four next year. We get the summary of economic projections in December. I think that you'll end at 4.25, the terminal rate, 4.25 for 2024 with 3.25. 3.25, maybe I'll go to 3.5 for the end of 2025. So instead of saying 4, maybe 3 next year, but from here, from where we are now, I think we're 4, maybe 5 rate cuts away. If there is any hiccup in the market, if the S&P pulls back 5%, 6%, if there's any bad data in the economic data, Trump will blame Powell for the high interest rates because they are now at war. And I will talk about that when we get down here. He said some things that maybe he shouldn't have said. Talking about the high level of yields, he was asked that. He said, we're watching long-term yields, sure. It does not seem to be about higher inflation expectations, though. He says it's not an issue yet. It would be material changes that last. And he made the example of last year when the 10-year went to 5%. He said everyone was talking about all sorts of things. And then a couple of weeks later, it was at 4.5. So he's not concerned about this at all. We are on a path to a more neutral stance. That has not changed since September. Even with today's cut, policy is still restrictive. Does that sound like somebody who's going to pause? No. Even with today's cut, policy is still restrictive. We are on a path. Yeah, I'd put 100% on December. The market's only putting about 64%. I think they're wrong. As we approach a neutral rate, we're not near it. Obviously, if you were near it, you wouldn't say as we approach. As we approach a neutral rate, may be appropriate to slow the pace of cuts, not stop. Slow the pace of cuts as we approach the neutral rate. They're on a rate cutting path. They're not there. I don't think they're going from data point to data point and meeting to meeting at this point. He did say that when it comes to the base effects at the end of last year, that the inflation reads were very, very low, but then jumped up in January. So he expects this year the opposite. That going into the end of the year, he'd expect the year over year to show an increase, but really drop off in January. Just to draw that out for you, I'll draw it out naively, okay, just so you can see it visually. But let's say we have a trend that's going up, and then it turns sideways for a while, and then it shoots up again. And you're watching the trend this year, and it's very, very stable. And you're looking at the year over year, very small, very small, very small. Look at these base effects. This is the base now, right? That's the base. It looks like it's getting worse, but if you look at the trend, I've drawn out a low volatility, very straight line. Looks like it's getting worse because last year's base effects were very low, and then it disappears in January because the January reading was very high. It says they're expecting this. So the last reading they got that was elevated a little, base effects. And going into the end of the year, even if the CPI and the PCE readings come in a little bit hotter than we would like them on the year over year, they understand that he said that in the press conference. And with everything else on inflation and yields that he said, they're not going from meeting to meeting making up their minds. I think they already have a path in mind. And it includes a lot more than 3 cuts in the next year, which is what Fed funds futures have. For the election, he started off okay. Does the election outcome change anything? He says it has no effect on future decisions. And then he said that's not a statement about the effect of policy, however. It's just a statement about the effect of the winner. Just because Trump won doesn't mean we're going to do anything differently. But his policies may cause us to do things based on the effect they have on the economy, but we're not changing anything just because one person won and the other one didn't. If asked to resign, no. Then a follow-on question to clarify, no, he's not going to resign, which is okay. You can get away with that. You can't get away with this. What about firings? Are you concerned about firings? And he said it as a sentence. The first time he said it as a sentence, and I'll repeat it the way he said it, not permitted under the law. See, that's a sentence, not permitted under the law. And then he said it again, but this time he put a period behind every word to punctuate it. It's like changing the font from 12 to 24 and clicking bold, underline, and italic all at the same time, right? He said, and I'll repeat it the way he said it the second time, not permitted under the law. Okay, that got a lot of press. That got a lot of coverage. I guarantee you Trump heard that. I guarantee you he knows about it. Now, it may be true that it's not permitted under law, but to stand up and go chest to chest and say, you can't touch me. You said that to the wrong guy. Here's what's going to happen. Every hiccup in the market, every hiccup in the economy, he's going to blame you. He's going to call you names. He's going to give you a nickname. He's going to ruin your reputation systematically over the next year. If the economy craters, it's your fault. it's your fault. If the deficit gets even bigger, it's your fault because of the interest expense. You're not cutting rates. You want to destroy the economy. You're an anti-Trumper. Heck, you might even be a Democrat. He is going to destroy that guy's life. He's going to call him names. He's going to turn the hate of the MAGA crowd towards him. Make his life a living hell. You shouldn't have said those words. Because to Trump, that is disloyalty. To stand in front and say, not permitted under the law. You can't touch me. This is going to be fun to watch. Okay, let's have a look at duration. Effective federal funds rate now sitting at 4.58%. Have a look at the long end of the curve, the 5-year out to the 30-year, all down week over week. And this is a week where we had the election and we had the FOMC. Those two big events down, and the long end of the curve coming down. You can see it down here. The blue line is this week. The red line is last week. You can see all this down week over week on the long end of the curve. If we look at the 2 to the 10, the slope on the 2 to the 10 flattened by 12 basis points. Now only 4 basis points positively sloped, threatening a second inversion. Even the 3-month to the 10-year flattened 9 basis points, negative 33. 741 days, I think we're going to beat the 788 days. This is Canada. Canada now has a money market to capital market inversion that is less than the U.S. It was always more. Now it is less than the U.S. So this is positive, I think, for duration. Combine what we saw on the previous screen, the language that he used to talk about yields, the language that he used to talk about inflation, tells me that they have more rate cuts already in their mind. They're not data dependent. They're not going from meeting to meeting. It's already in their mind. And for TLT to perform this well after the election, it did not. It broke 90 and it started selling off. You had an 8 handle on it, an 80 handle. And then it just came right back up. Had a good, strong finish to the week. Thursday was good. Friday was good. With that behind it, if it was going to be taken down, it would have been taken down from that. But it wasn't. And I think we got many more rate cuts ahead of us over the next 12 months. We have CPI in 3 days and PPI in 4 days. And they are expecting, as I said on the previous screen, that there might be some base effects which make inflation look more stubborn than what it really is. But in their minds, as they went through everything, the inflation problem is solved. It's not wages. It is not non-housing services and goods. It's just housing. In their mind, it's solved. So any weakness on TLT here, I'm probably going to add to that position because I am more convinced now that TLT, or duration I should say, TLT is just a vehicle in which to get duration exposure, but duration I think is going to be a great performer over the next year, more so than the market has priced in right now. For the peso, we get an interest rate decision in 4 days. While Trump was winning, the peso hit 2050 and then 2075, and I shorted it at both these levels. And Friday during the day, we got to 19.8 something. So I covered some of what I had put on. I covered some and left the rest open. Ended at 20.17. I don't know. I don't know that we'd get much strength this week. There is some chatter that a Trump appointment, he reappointed the last trade representative, Lighthizer, who has sort of presented a plan to weaken the U.S. dollar. That would be interesting in terms of an alternative to tariffs, because you got to think, well, if we don't do tariffs, what can we do to close the trade deficit? A weaker U.S. dollar would be a killer, would be a thing to do. So if that narrative starts to gain strength and you have a weakening U.S. dollar, you could have a strengthening peso even with an interest rate cut ahead of it. But with two uncertainties, the direction of the U.S. dollar right now and the interest rate cut, I'm on hold with the peso. That's the smart thing to do. December FOMC is 38 days away. And I do think the market has it wrong. By the way, these should be reversed. The 25 basis point cut, 64.6%, was 82. So it was a drop down to 64. And no change is now 35%, up from 17. I think this is wrong. I think that's 100% based on what I heard. I put that at 100%. Look at the reverse repo, 163 billion. The lowest level was hit on November 5th at 144 billion. Reserve sitting at 3.2. So excess over ample. My guess as to ample is 919 billion at 40 billion a month, 23 months. My guess is by the second quarter of 25, they'll be talking about slowing the pace of this down because they don't want to run right to the level that they think is ample. They want to slow down into it to make sure that they don't stress anything in the money market. Sorry, I should have said repo market. Stress anything in the repo market. TLT week over week up 1.82. SPX up 4.66. We'll talk about beta on the next screen. China, this is important to look at, I think. China CPI year over year. Look at this number, 0.3. That is year over year, 0.3. Threatening deflation. Month over month already showing deflation, negative 0.3. PPI year over year, well in deflationary territory, negative 2.9%. If you have prices coming down in China and you stick a tariff on them, it may end up being after the tariff and after the deflationary pressure, maybe the same price or not that much higher than it was before. By the way, China's already taking some moves in anticipation of the tariffs, and this is the problem with linear thinking. Is linear thinking doesn't include within it strategic responses from other people. You have to think that way. You can't think linearly. You have to think non-linearly. In the positions video for November 15th, we're going to take a deeper look at the effect of tariffs, and I'm going to show you how to think about it using two theories, because when you do PhDs, you play with theory a lot, and some of the most interesting things come from combining two theories together. So we're going to combine game theory. We're going to think about tariffs from a game theoretic perspective, and we're going to think about it from a complexity theory perspective. We're going to combine the two and see what we get. You cannot think linearly when it comes to complex systems. That is always going to lead you to excessive outcomes that are simply not true. You have to think about the nonlinearity. So we're going to do that in the positions video this Friday in the applied level. Let's look at Fed funds futures. This is for January, April, July, and October. So you can see where we're getting from here, from 4.58 all the way to October over here. Q1 has 17.5 basis points left to go in there. I think that is 25 clearly. Q1 23.5. I'm going to say that's 50. Q2 25. I'll go 25 there. That's 20.5 and negative 12.5. I'd say stick another 25 in there. So I'm 125 without being aggressive versus 74. 3 rate cuts in 8 meetings. 3 in 8 meetings, and I think December is a shoe-in based on what they've said. So 2 cuts in 7 meetings to get to the end of October. 2 cuts in 7. I think that's wrong. So in the positions video I put up for November 8th, I did talk about ZQ and what I was doing on ZQ, but there is an opportunity there. I see strong opportunities on both ends of the curves. I see opportunity on the effective federal funds rate. I think the market is thinking too much about inflationary pressure under a Trump regime. I don't think that'll be the case, and I think they're underappreciating how much performance duration will provide. Okay, let's move on to beta. Wednesday all-time high, Thursday all-time high, Friday all-time high, 598.19, all-time high November 8th on that one. Forward 4-quarter operating earnings 263.88. Last week was 264.67. The week before, 265.03. A step down, a step down. The market, a step up, a step up. You can see what's going on there. So 21.65 times forward earnings. We've added a whole multiple in 1 week on earnings estimates, operating earning estimates coming down. Not a lot, but still wrong direction. So the market has no choice but to get more expensive. 22.72 times forward earnings, threatening 23 times. If we're going to round off, it's 23 times forward earnings. A whole multiple added week over week. Lots of euphoria in here. And the narrative, which is something you can't fight. You can't fight a story, especially when the fundamentals to the story are 2, 3, 4 quarters in the future, or even a year or two in the future. You can't fight the story. But you can watch the evolution of the story. We know who Trump is. I'm pretty sure his first year in Trump 2.0 will look like Trump 1.0. He spent his first year in 2016 relentlessly erasing everything Obama did without question. Relentlessly erasing everything any other president did without question. It had to have his name on it. NAFTA, it's got to go. We got to renegotiate that. Obamacare, got to go. Almost everything Obama did, well over 100 things, he just would, no, got to go, without even reading it. Well, that's what his first year will be like. He'll reverse everything that doesn't have his name on it. He will spend a disproportionate amount of his time settling grievances. He's got a list of names. He'll start with the Justice Department. And anybody in there, anybody who had anything to do, who was in any meeting whatsoever about any Trump case, will lose their job. He will begin to appoint, well, we know the Justice Department's getting a new lead. We know Treasury is going to get somebody new as well. Pretty much every department's going to get somebody new. They will have in rank order of qualities, number one will be loyalty. He will appoint loyalists who will do what he wants done. Then he'll look for qualification, but loyalty above all. He will spend his first year settling grievances. Most of the big things he wants done, he can't get done without Congress. And it's going to be very difficult to get done because you have a rising number of Republicans coming out as deficit hawks. It's going to be hard to get tax cuts put in place without showing how you're going to get spending cuts. It's going to be hard to get spending cuts if spending cuts affect a Republican in their own district. So we'll talk about that at the very end here. But this narrative that by the end of the week, so many things had changed. Trump had gained almost godlike status. He is no longer a liar. I'm not sure if you are aware of that. He never lied. That is a lie put out by the Democrats and the liberal media that he lies. We all can hear him talk. I mean, we know. He wasn't, January 6th was nothing. It was that, again, is another lie put out by the Democrats. And everything, all of the trials, they were in fact actual witch hunts. He never actually did anything wrong. And now he's going to save the world. He's going to end all the wars, end world hunger. He's going to clean the rivers. He's going to clean the air. He speaks directly with God. He got godlike status by the end of the week. That everything good that can happen is absolutely going to happen. And that is not Trump. Trump is a petty man who will spend most of his time settling petty grievances. And he still, even though he has a mandate, he's still got to get things through Congress. And you have to get other people to vote for it. And of course, they're self-interested as well, so they're going to want their thing. And if we look at his first administration, some of the big things that he wanted didn't really happen, for the first year. Still, you have the story. So it's not as if the narrative will disappear, and this market has shown itself to be willing to believe that everything is going to happen with absolute perfection. Implied volatility, even to add to this, you have this nice run up here and nothing to see here. Look at that. Implied volatility, the 3rd percentile. From the 88th percentile last week down to the 3rd percentile. Even on TLT from the 97th percentile down to the 29th percentile. Nothing to see here, folks. IWM 238.12 up 8.74% week over week. All-time high is 241.67, sitting 1.5% below an all-time high. IJR is at an all-time high, or did hit an all-time high Wednesday, November the 6th, and is sitting 15 cents below that all-time high as of the close of Friday, up 8.71% week over week. Profitable small cap, unprofitable small cap, both with the same performance. That doesn't seem logical to me. We have earnings this week. I've just put some more. There are more companies than this, but I just put the interesting ones down. Home Depot on Tuesday, 7.6% of the XLY. Expectation is 3.64 EPS. Oxy, expectation is for 74 cents. Tyson Food, expectation at 72. Wednesday, Cisco, which has a big presence in cybersecurity, 87 cents. Disney $1.10 on Thursday. Applied Materials $2.19, and the king of it all is Nvidia. We don't get that till next week, November 20th. The expectation is 74 cents. 14.68% of the XLK. That's for the tech sector. That's a big weighting in there, and a big weighting in the S&P. Since they're on their last earnings report, if you had followed their guidance all the way down to EPS, they were basically guiding to a flat EPS. However, since the last quarterly report and now, there has been news coming out of Nvidia, particularly about demand for Blackwell. Sold out for the next 12 months. Demand is unbelievable, off the charts, which could mean higher prices, bigger margins, and that 74 cents could easily be 94 cents. You get a beat like that. The AI story is still very much alive, and that is, again, adding to the narrative, right? So as of November 20th, you'll have that. Add that to the growing godlike narrative surrounding Trump. I mean, the fact that he's not nominated for a Nobel Peace Prize is rather shocking. But by the end of next week, we might hear that he's that he should be nominated for a Nobel Peace Prize because he will end all the wars on the planet. That is that is the direction of the narrative right now. It's hard to fight that. I mean, it is silly to stand in the way of that. But that the reality will not match the narrative. That we know. So there will be a reckoning in the market at some point, and that reckoning in the market will be blamed entirely on Powell. That's a nice place to be in. Let's have a look at how difficult his job is going to be and why I think the market is not really thinking very clearly, because the market is thinking linearly, and you have to think in terms of trade-offs. In Q1 of 2016, when he stepped into the office, debt was 19.27 trillion and interest payments were 446 billion. That puts a blended interest rate on the debt portfolio of 2.3%. Now he'll be stepping in when the debt is 34.8 trillion. Pause for a moment. That's 8 years. 8 years, $15 trillion to the debt. $15 trillion was added to the debt in 8 years. Interest payments are now $1.16 trillion, a blended rate of 3.21%. Higher debt, higher interest rate. You have almost, pushing up almost triple on the interest payments. That has to be paid. Cut expenses all you want, but that has to be paid, which means you've got to cut even more in other places. The last fiscal deficit was 1.8 trillion. That's a deficit. Imagine that you make $1,000 a month and you spend $1,200 and you owe $5,000 on your credit card. Well, you can't make any payment on your credit card because you're spending 12 and you only make 1,000. Even if you cut spending to 1,000, you still can't pay anything on your card. You have to get it below to be able to start paying down your credit card. To fix this problem, one of two things has to happen, or one or both has to happen. You either get the debt level down or you get the interest rate down. Well, the interest rate is something that you can control, and Trump, with his typical name calling and bullying, will start putting pressure on the Fed. And they have to know that any bad data, they're going to be blamed for it. He will ruin reputations. They must be aware of that you would say not permitted under the law. You had to know the moment those words came out of your mouth. You had to think, okay, well, that relationship's done, and I know what he's like. 1.8 trillion, that is your deficit. How are we going to get tax cuts? Tax cuts would increase the deficit, which would increase all of this, which would make things, which would just make things worse. You have a growing number of deficit hawks in Congress. They're going to want to see that your tax cuts are neutral, which means you got to cut spending. You got a Republican in this district, a Republican in this district saying, no, not in my district. This one, no, not in my district. Nobody's going to want spending cuts in their district. Not only that, if you try to balance the budget, if you try to go to zero, you take 1.8 trillion out of the market. When I say the market, I mean more the real market, the economy itself, because every dollar you transfer or spend is another the other side's income or revenue. So you're taking that out of the economy. I just don't see how you're going to get that done. How are you going to get from a deficit of 1.8 trillion to zero without taking 1.8 trillion of income out of the economy, without hurting the economy, number one, and then instituting tax cuts on top of that, which would only create another deficit, which would keep this number high, which is some number that you cannot cut. So when you play it out, there is no good ending for this. The only good ending for this is massive rate cuts, very fast rate cuts, spending cuts that equal the tax savings. I still don't see how you're getting back to zero on this. So because I don't think you can get back to zero, what's the only real lever you have here is the interest rate. Yet another reason why I think duration will continue to perform, because Trump will get what Trump wants. And if he can't replace Powell until 2026, he will make his life a living hell up to that point. So that is where we are.